When you're over 60, everything about investing changes. You're no longer building wealth for some distant retirement. You're living off that wealth or about to start living off it. You don't have 30 years to recover from mistakes. You can't afford to chase the hot stock that might double or might go to zero. What you need are stocks so reliable, so profitable, so dominant in their industries that you can buy them and never worry about selling them. Stocks that will pay you increasing dividends every year. Stocks that will be worth more when you're 80 than they are today. Stocks that will survive recessions, market crashes, technological changes, and everything else the world throws at them. I'm Warren Buffett. I'm 94 years old. I've been investing for over 80 years. And I'm going to tell you about 5 stocks that I would never sell if I were 60 years old today. These aren't speculative plays. These aren't growth stocks that might work out. These are the safest, highest quality businesses on earth. Companies I'd be comfortable owning for the rest of my life. Companies that will take care of you in retirement. Companies that will keep paying you even when you're too old to work. Today, I'm going to explain which 5 stocks these are, why they're perfect for investors over 60, how they generate income, and why I'd never sell them no matter what happens in the market. Before I reveal the 5 stocks, let me tell you what makes a stock appropriate for someone over 60, because the criteria are very different than for younger investors. When you're 30, you can swing for the fences. You can buy high-growth companies with no profits. You can take risk. If things don't work out, you have decades to recover. When you're 60, you can't do that. You need different characteristics. First, established businesses with long track records. You want companies that have been around for 50, 70, 100 years. Companies that have proven they can survive anything. Not startups, not new business models, proven winners. Second, consistent profitability and cash flow generation. You want companies that make money every single year, not just in good times, in bad times too, in recessions, during wars, through technological disruptions. Companies with business models so strong that they stay profitable no matter what. Third, dividends with long histories of increases. When you're over 60, dividends become critical. You might need that income to live on. Even if you don't need it now, you want dividends that grow every year because that's your inflation protection. Companies that have paid and increased dividends for 20, 30, 40, 50 years or more, that's what you want. Fourth, strong competitive advantages or moats. You want businesses that competitors can't easily challenge, brand power that took decades to build, network effects that get stronger over time, economies of scale that make them low-cost producers, regulatory barriers, something that protects the business from competition. Fifth, minimal technology disruption risk. When you're 60, you don't want to own businesses that could be made obsolete by some new technology. Stay away from things that are changing rapidly. Stick with businesses based on fundamental human needs and desires that don't change. Sixth, strong balance sheets with low debt. Companies with clean balance sheets can weather any storm. They don't face bankruptcy risk and recessions. They can keep paying dividends even when times are tough. Low debt means safety. Seventh, management you can trust. When you're buying stocks to never sell, you're essentially entering a partnership with management. You need people who are honest, competent, and thinking long-term. People who treat shareholder money like their own. These 7 criteria define the perfect stocks for investors over 60. And the 5 I'm about to tell you about have all 7. Let me reveal them now. Stock number 1 is Coca-Cola. I've owned Coca-Cola since 1988. Berkshire bought 5% of the company for $1 billion. Today, that stake is worth about $25 billion and generates over $700 million in annual dividends. Every year, Coca-Cola sends Berkshire $700 million. We don't do anything. We just own the stock. That's the power of dividends from a great business. And if I were 60 years old today with limited capital, Coca-Cola would be the first stock I'd buy and the last stock I'd ever sell. Let me tell you why Coca-Cola is perfect for investors over 60. First, the dividend is exceptional and reliable. Coca-Cola has paid dividends for over 100 years. They've increased the dividend for 62 consecutive years. This is dividend king status. Only a handful of companies have done this. The current yield is about 3%. That's higher than the 10-year Treasury bond. But unlike a bond that pays fixed interest, Coca-Cola's dividend grows. It's grown at about 5 to 7% annually for decades. If you buy Coca-Cola today at 60 years old and hold until you're 80, your dividend will have roughly doubled. If you invest $100,000 today, you get $3,000 per year in dividends. In 20 years, you'll be getting about $6,000 per year. And you still have your $100,000 in stock, which will probably be worth $200,000 or more. This dividend growth is your inflation protection. As the cost of living rises, your dividend income rises to match. Second, the business model is nearly indestructible. Coca-Cola sells happiness in a bottle. 2 billion servings per day are consumed globally. People have emotional connections to Coke products that transcend logic. They don't drink Coke because it's the healthiest choice. They drink it because it makes them feel good, because it reminds them of childhood, because it's part of celebrations and memories. This emotional bond is the strongest moat a business can have. Competitors can copy the formula. They can match the price, but they can't replicate the feelings people have about Coca-Cola that took 139 years to build. Third, Coca-Cola has adapted to changing consumer preferences. Yes, soda consumption is declining in developed markets. People are more health conscious. But Coca-Cola isn't just a soda company anymore. They own Dasani and Smartwater, Honest Tea, Simply Orange, Minute Maid, Fairlife Milk, Costa Coffee, Powerade. They're a total beverage company. When consumers shift from soda to water or juice or coffee, they shift to another Coca-Cola product. The company doesn't lose, it just redirects revenue. Fourth, international growth is substantial. In wealthy countries, per capita consumption is high, growth is modest. But in developing markets, Africa, Southeast Asia, India, parts of Latin America, per capita consumption is low. As these economies grow and people enter the middle class, they buy more beverages. Coca-Cola is already there with distribution and brand recognition. This gives the company a growth runway for decades. Fifth, the balance sheet is solid. Coca-Cola has reasonable debt levels relative to earnings. They generate about $10 billion in free cash flow annually. This cash flow easily covers the dividend and leaves room for growth, investments, and debt reduction. There's no bankruptcy risk. Even in a severe recession, Coca-Cola will stay profitable and keep paying dividends. Sixth, management is trustworthy. CEO James Quincy has done well expanding the portfolio and maintaining capital discipline. The board is aligned with shareholders. They're not making stupid acquisitions or taking excessive risk. They're running the business conservatively for long-term value creation. For someone over 60, this is exactly what you want. Let me tell you what you do with Coca-Cola. You buy it today at about $60 per share. Let's say you invest $50,000. That's about 833 shares. At 3% yield, you're getting $1,500 per year in dividends. You set those dividends to automatically reinvest. Every quarter, the dividend buys you more shares. Over time, your share count grows. In 10 years, with dividend reinvestment and dividend growth, you might own 1,100 shares. Your annual dividend is now about $4,000 on your original $50,000 investment. That's an 8% yield on your cost basis. In 20 years, you might own 1,500 shares. Annual dividend is 7,500. That's a 15% yield on cost. And your shares are probably worth 100,000 or more. You've doubled your capital and you're earning 15% annually on your original investment. This is how wealth compounds in retirement. You never sell Coca-Cola. You just hold it forever and collect growing dividends. Stock number 2 is American Express. Berkshire has owned American Express since the 1960s. We own over 20% of the company. It's one of our largest positions, and we haven't sold a single share in decades. American Express is a perfect stock for investors over 60 because it combines dividend income with steady growth and an incredibly strong competitive moat. Let me explain why American Express is a never-sell stock. First, The business model is superior to competitors. American Express is different from Visa and MasterCard. Visa and MasterCard are payment networks. They process transactions but don't lend money. American Express is a closed-loop system. They issue cards to consumers. They sign up merchants. They process the transactions, and they extend credit to cardholders. This means American Express makes money in three ways. Discount fees from merchants, usually 2 to 3% of transaction value. Interest from cardholders who carry balances. Annual fees from premium cards. Visa and MasterCard only make money one way, processing fees. American Express makes money three ways. This generates higher revenue per transaction. Second, American Express targets affluent customers. The average American Express cardholder spends far more than the average Visa or MasterCard holder. They have higher incomes. They use their cards for more transactions. They pay annual fees for premium cards like Platinum and Centurion. These customers are less price sensitive. They value the benefits American Express provides. Travel perks, purchase protection, customer service, rewards programs. They're loyal. Once someone becomes an American Express customer, they tend to stay. This creates stable recurring revenue. Third, the network effect is powerful. The more consumers have American Express cards, the more valuable it is for merchants to accept American Express despite higher fees. The more merchants accept American Express, the more valuable American Express cards become to consumers. This reinforcing cycle creates a moat that's difficult to breach. Fourth, American Express has pricing power. Every year, they raise fees slightly. Merchants complain but pay because they can't afford to lose American Express customers who spend more. Cardholders pay annual fees of $595 for Platinum cards, $10,000 for Centurion cards. They pay because the value exceeds the cost. This pricing power means American Express can grow revenue even if transaction volume growth slows. Fifth, the dividend is strong and growing. American Express currently yields about 1.3%. Not huge, but the dividend has grown at double-digit rates over the past decade. The payout ratio is about 20% of earnings, very conservative. This means massive room for dividend growth. Over the next 10 years, the dividend could easily triple or quadruple as earnings grow and the payout ratio increases. Sixth, the balance sheet is strong. American Express is a financial company, so they do have credit risk from lending to cardholders. But they manage this risk well. Charge-off rates are low. They reserve appropriately for potential losses. The capital ratios exceed regulatory requirements. Even in the 2008 financial crisis, American Express stayed profitable and kept paying dividends. Seventh, management is excellent. CEO Stephen Squeri has done well focusing on high-spending customers and expanding benefits. The company invests heavily in technology and customer experience. They're not resting on past success. They're innovating and staying relevant. If I were 60, I'd buy American Express and never sell. Here's what that looks like. You invest $50,000 at about $280 per share. That's about 178 shares. At 1.3% yield, you get $650 in annual dividends. Not much initially, but watch what happens. The dividend grows at 12% annually, which is conservative based on history. In 10 years, your annual dividend is about $2,000. In 20 years, it's about $6,200. Your yield on cost is 12%. And the stock price has probably tripled or quadrupled. Your $50,000 is worth $150,000 to $200,000. You never sold. You just held and collected growing dividends. Stock number 3 is Apple. Now, some people are surprised when I say Apple is a never-sell stock for investors over 60. They think of Apple as a technology company, risky and subject to disruption. But that's not how I see Apple. Apple is a consumer products company that happens to use technology, and it's one of the highest quality businesses I've ever seen. Berkshire owns about $150 billion of Apple stock. It's our largest position. And I have no intention of selling. If I were 60 today, Apple would absolutely be a never sell stock. Let me tell you why. First, the ecosystem creates incredible customer loyalty and recurring revenue. Once you buy an iPhone, you're in the Apple ecosystem. You buy AirPods because they work seamlessly. You buy an Apple Watch because it integrates perfectly. You buy a MacBook because everything syncs. You subscribe to iCloud for storage. You buy apps from the App Store. You subscribe to Apple Music, Apple TV Plus, Apple Fitness. Every product makes every other product more valuable, and every addition makes it harder to leave. This isn't manipulation. This is brilliant business design. The switching costs are enormous. If you leave Apple, you lose all your purchased apps, your sync data, your integrated devices. Very few people switch once they're in the ecosystem. This creates recurring revenue that grows every year. Services revenue is now over $80 billion annually and growing at double digits. This is higher margin than hardware and more predictable. Second, Apple has over 1 billion users in the ecosystem. Each user generates hundreds of dollars per year in revenue through device purchases, app purchases, subscriptions. As the user base grows and revenue per user increases, total revenue compounds. Even if iPhone unit sales plateau, Apple keeps growing through services and wearables. Third, the financial strength is unmatched. Apple generates over $100 billion in free cash flow annually. This funds massive share buybacks and dividends. Over the past decade, Apple has bought back probably $400 billion of stock. This is why earnings per share have grown much faster than revenue.
Fewer shares outstanding means each remaining share owns a larger piece of the business. Apple also pays a dividend, currently yielding about 0.4%. Not high, but it grows every year.
And combined with buybacks, total shareholder return is excellent. Fourth, the brand is one of the most valuable in the world. People pay premium prices for Apple products. An iPhone costs more than competing smartphones. People pay anyway because they value the quality, design, and ecosystem. This brand power gives Apple pricing power. They can raise prices modestly every year and customers accept it because the value justifies the cost. Fifth, Apple is transitioning from hardware company to services company. Services have much higher margins and are more recurring. Over the next decade, services could become 50% or more of revenue. This mix shift improves profitability and reduces cyclicality. Sixth, international growth is significant. About 40% of revenue comes from outside the United States. As emerging markets develop, smartphone penetration increases. Apple is positioned to capture this growth in China, India, Southeast Asia. Seventh, management is exceptional. CEO Tim Cook has done brilliantly. He's strengthened the ecosystem, grown services, returned massive cash to shareholders, maintained operational excellence. I trust him completely to allocate capital wisely. If I were 60, I'd buy Apple and hold forever. Here's the math. You invest $50,000 at about $230 per share. That's about 217 shares. The dividend is small, about $87 per year. But watch what happens. Apple buys back about $90 billion in stock annually. This is about 3% of market cap. So your ownership stake in Apple grows by 3% per year just from buybacks. After 10 years, your 217 shares effectively own what 290 shares owned before due to the shrinking share count. After 20 years, it's like owning 390 shares. The stock price compounds at about 8 to 10% annually. In 20 years, your 50,000 becomes about 250 to 300,000. You never sold. You just held and let buybacks increase your ownership stake. Stock number 4 is Johnson & Johnson. This is a healthcare giant that's been around for over 130 years. They operate in 3 segments: pharmaceuticals, medical devices, and consumer health. This diversification across healthcare makes Johnson & Johnson incredibly stable. Berkshire doesn't currently own Johnson & Johnson, but if I were 60 years old, starting fresh, it would absolutely be a never sell stock. Let me explain why. First, the dividend is world-class. Johnson & Johnson has paid dividends for over 80 years. They've increased the dividend for 62 consecutive years. Dividend king status. The current yield is about 3%. The payout ratio is about 50% of earnings, very sustainable. The dividend grows at about 5 to 6% annually. If you're 60 and you hold Johnson & Johnson until 80, your dividend will more than double. This growing income stream is perfect for retirement. Second, the business is non-cyclical. Healthcare demand doesn't depend on the economy. People need medicines whether there's a recession or boom. They need medical devices. They need healthcare products. Johnson & Johnson's revenue stays stable even in severe recessions. During the 2008 financial crisis, when most companies saw revenue decline, Johnson & Johnson kept growing. This stability is critical when you're over 60. You can't afford big drawdowns in your portfolio. Healthcare stocks provide ballast. Third, the diversification across healthcare segments reduces risk. If pharmaceutical sales slow, medical device sales might compensate. If one segment faces regulatory challenges, others keep performing. This built-in diversification is like owning 3 companies in one stock. Fourth, the pipeline of new drugs is strong. Johnson & Johnson has over 14,000 patents. They spend about $15 billion per year on research and development. This creates new drugs that replace older drugs going off patent. The pipeline ensures future growth, even as current drugs face competition from generics. Fifth, the balance sheet is fortress strong. Johnson & Johnson has a AAA credit rating, one of only 2 U.S. companies with this rating. They generate about $25 billion in free cash flow annually. Debt is manageable, even in a depression-level scenario. Johnson & Johnson would stay profitable and keep paying dividends. This safety is priceless when you're over 60. Sixth, the moat is wide. Johnson & Johnson has brand power in consumer products like Tylenol, Band-Aid, Listerine. These brands have been trusted for generations. In pharmaceuticals, they have patent protection and relationships with doctors and hospitals built over decades. In medical devices, they have regulatory approvals and installed bases in hospitals globally. All of this creates barriers to competition. Seventh, management has navigated challenges well. Johnson & Johnson faced lawsuits related to talc in their baby powder and opioid sales. These were serious issues, but management settled appropriately, took responsibility, and moved forward. They spun off the consumer health business to focus on higher growth pharmaceuticals and medical devices. They're making smart capital allocation decisions. If I were 60, here's what I do with Johnson & Johnson. Invest $50,000 at about $160 per share. That's about 312 shares. At 3% yield, you get $1,500 per year in dividends. You reinvest these dividends automatically. The dividend grows at 6% annually. In 10 years, your annual dividend is about $2,700. In 20 years, about $4,800. Your yield on cost is almost 10%, and your shares are worth about $80,000 to $100,000. You never sold. You held through market crashes, lawsuits, regulatory changes. Johnson & Johnson kept paying you every quarter. The dividend kept growing. This is exactly what you want over 60. Stock number 5 is Berkshire Hathaway, the company I run. Now, you might think it's self-serving for me to recommend my own company, but hear me out. Berkshire Hathaway is uniquely suited for investors over 60 who want to never sell stock. Let me explain why. First, Berkshire is a diversified conglomerate. We own over 60 operating businesses across insurance, railroads, utilities, manufacturing, retail, services. We also own large positions in public companies like Apple, Bank of America, Coca-Cola, American Express. When you buy Berkshire, you're buying a mini mutual fund of high-quality businesses. This diversification reduces risk. If one business struggles, others compensate. Second, the insurance float is a perpetual source of low-cost capital. We own Geico, General Re, and dozens of other insurance companies. These businesses collect premiums up front and pay claims later. The money sits with us in the meantime. This is called float. We have about $160 billion in float. We invest this money and keep the investment returns. It's like having an interest-free loan of $160 billion that never comes due. This float compounds our returns significantly. Third, we have a fortress balance sheet. Over $130 billion in cash and treasury bills, no debt at the holding company level. Operating businesses have modest debt In a financial crisis, we have the capital to buy assets cheap while everyone else is forced to sell. This financial strength means Berkshire can survive and thrive in any environment. Fourth, the operating businesses generate enormous cash flow, about $40 billion per year from our wholly owned businesses. This cash flow funds acquisitions, buybacks, and builds the cash pile. We don't pay a dividend, which some people see as a negative, but I see it as a positive. Why? Because I can reinvest that cash at higher returns than you can. If we paid out $40 billion in dividends, you'd get the cash and pay taxes on it. Then you'd have to reinvest it yourself, probably at lower returns than we can get. Better for us to keep the cash, reinvest it at 15 to 20% returns inside Berkshire, and let the value of your shares compound. Fifth, share buybacks increase your ownership stake. When Berkshire trades below intrinsic value, we buy back stock. We bought back over $70 billion of stock over the past several years. This reduces share count. Your ownership of Berkshire's businesses increases without you doing anything. It's like getting a dividend that's automatically reinvested at good prices. Sixth, management succession is planned. I'm 94. I won't be running Berkshire forever, but we have a clear succession plan. Greg Abel will become CEO when I'm gone. He's been with Berkshire for decades. He understands the culture and the capital allocation philosophy. He'll run Berkshire the same way I have. The board is strong. The company will continue long after I'm gone. Seventh, the culture of integrity and long-term thinking is embedded. Berkshire doesn't chase quarterly earnings. We don't play accounting games. We don't make stupid acquisitions to grow revenue. We think in decades. We prioritize per share value creation over everything else. This culture attracts great businesses and great managers. It ensures Berkshire will keep compounding for generations. If I were 60, I'd absolutely buy Berkshire and never sell. Here's what that looks like. You invest $100,000 in Berkshire Class B shares at about $450 per share. That's about 222 shares. Berkshire doesn't pay a dividend, so you don't get income. But the intrinsic value compounds at about 10 to 12% annually as our businesses grow and we allocate capital well. In 10 years, your $100,000 is worth about $270,000. In 20 years, about $700,000. Your wealth compounds tax deferred because you never sell. When you need income in retirement, you can sell small amounts of stock. Or you can borrow against your Berkshire shares at low interest rates and never pay capital gains tax. Berkshire is the ultimate never sell stock for anyone who wants their wealth to compound for decades. Now let me talk about how to actually implement this 5-stock portfolio if you're over 60. The allocation I recommend is this: Coca-Cola 20%, American Express 20%, Apple 25%, Johnson & Johnson 20%, Berkshire Hathaway 15%. This gives you diversification across consumer staples, financial services, technology, healthcare, and a conglomerate. You have domestic and international exposure. You have dividend income from 4 of the 5 stocks. You have growth from all 5. Let's say you have $250,000 to invest. That's your retirement portfolio. Here's the allocation. Coca-Cola $40,000, about 666 shares. American Express $50,000, about 178 shares. Apple $62,500, about 271 shares. Johnson & Johnson $50,000, about 312 shares. Berkshire Hathaway $37,500, about 83 shares. In year 1, your dividend income from Coca-Cola is $1,200. From American Express, $650. From Apple, about $100. From Johnson & Johnson, $1,500. Total dividends are $3,450. That's a 1.38% yield on the portfolio. Not high, but watch what happens. The dividends grow. After 10 years, your annual dividend income is about $8,000. After 20 years, about $17,000. Your yield on cost is almost 7%. And your portfolio value has probably doubled or tripled to $500,000 to $750,000. You never sold a single share. You just held and collected growing dividends. Now, some people will say, what about diversification? 5 stocks isn't enough. You're taking too much risk. Here's my response. These 5 stocks are more diversified than most people's entire portfolios. You have exposure to consumer goods, financial services, technology, healthcare, insurance, railroads, utilities, manufacturing, You have domestic and international revenue. You have different types of competitive advantages: brand power, network effects, ecosystems, patents, scale. This is plenty of diversification for someone who understands these businesses deeply. I'd much rather own 5 great businesses I know inside and out than own 50 businesses I barely understand. Concentration builds wealth when you choose wisely. Diversification protects wealth when you don't know what you're doing. If you know these 5 businesses and you're confident in their competitive positions, 5 is enough. Now let me address market timing. Should you buy all 5 stocks today, or should you wait for a crash and buy them cheaper? My answer is simple. Buy them today. Don't try to time the market. Yes, these stocks might be cheaper next year if there's a recession, but they also might be more expensive. And while you wait, you're missing dividends, you're missing growth. Timing the market beats timing the market. If you have $250,000 to invest, I'd deploy it over 6 months, invest about $40,000 per month, split across the 5 stocks. This dollar cost averaging smooths out any short-term volatility. But don't wait years for the perfect price. These are great businesses. Buy them at fair prices and hold forever. The specific entry price won't matter in 20 years. Now let me tell you what to do when the market crashes, because there will be crashes, maybe next year, maybe in 5 years, but there will be a time when your $250,000 portfolio drops to $150,000, a 40% decline. This is terrifying. Every instinct tells you to sell, to preserve what's left, to avoid further losses. Here's what you do instead. Nothing. You hold. You don't sell a single share. Why? Because these 5 businesses are still great. Coca-Cola is still selling 2 billion servings daily. American Express customers are still using their cards. Apple's ecosystem is still valuable. Johnson & Johnson is still selling medicines and medical devices. Berkshire's businesses are still operating and generating cash flow. The stock prices crashed, but the businesses didn't. In fact, the businesses are probably worth more because they're buying back stock at cheap prices. Apple buying back $90 billion in stock when the stock is down 40% retires way more shares than when prices are high. This is good for you as a shareholder. The dividends keep coming. Every quarter, Coca-Cola sends you your dividend. Johnson & Johnson sends you your dividend. These dividends buy more shares when prices are low. You're accumulating shares at a discount. When the market recovers, and it always does, you own more shares than before the crash. You're better off for having held through. This is why these 5 stocks are never sell stocks. The businesses are so strong that crashes don't threaten their survival. There are opportunities to accumulate more shares. If you sell during a crash, you lock in losses. You miss the recovery. You never make your money back. If you hold, you recover fully and continue compounding. History proves this. Every crash has been followed by a recovery and new highs. The 1973 to 74 crash, the 1987 crash, the 2000 to 2002 bear market, the 2008 financial crisis, the 2020 COVID crash. All of them recovered. All of them were buying opportunities in retrospect. But you can only benefit if you hold. Now, let me give you specific guidance on living off this portfolio in retirement. Let's say you're 65 and you have this 5-stock portfolio worth $500,000. You're retired. You need income to live on. How do you manage it? Strategy 1, live off the dividends only. Your dividend income is probably about $15,000 to $20,000 per year. If you can live on this amount plus Social Security, you never have to touch your principal. Your portfolio keeps growing. The dividends keep increasing. In 20 years, you're getting $40,000 to $50,000 per year in dividends. Your lifestyle improves over time. This is the ideal scenario. Strategy 2, supplement dividends with small stock sales. If you need $40,000 per year to live and dividends provide $20,000, you need to generate another $20,000 from stock sales. Sell 2 to 3% of your portfolio annually. This is sustainable. The portfolio grows at 8 to 10%. You're selling 2 to 3%. The net growth is 5 to 7%. Your portfolio keeps growing even as you take income. Strategy 3, borrow against your portfolio. Stocks can be used as collateral for low-interest loans. You could borrow $20,000 per year at 2 to 3% interest using your stocks as collateral. You never sell. You never pay capital gains tax. The loan interest is tax deductible if used for investment purposes. Your portfolio keeps growing. Eventually, you can pay off the loan from dividends or estate planning. This strategy requires discipline but can be very tax efficient. My recommendation is to combine strategies. Live off dividends as much as possible, supplement with small stock sales when needed, use portfolio loans opportunistically when it makes sense, be flexible based on circumstances. Now let me address the question of taxes, because how you hold these stocks matters for tax efficiency. If you're over 60, you probably have money in several types of accounts. Traditional IRA or 401k, Roth IRA, taxable brokerage account. Where should you hold these 5 stocks? Here's my recommendation. Hold Coca-Cola and Johnson & Johnson in your taxable account. These pay significant dividends. In a taxable account, qualified dividends are taxed at 0, 15, or 20% depending on your income, lower than ordinary income tax rates. And you only pay tax on the dividends, not on unrealized gains. This is efficient. Hold American Express and Berkshire in your Roth IRA if you have one. These don't pay much current income. They grow primarily through price appreciation. In a Roth, all growth is tax-free forever. When you withdraw in retirement, 0 taxes. This maximizes the benefit of their growth. Hold Apple in either Roth or taxable, depending on space. Apple has modest dividends and good growth. It works well in either account type. If you don't have enough Roth space for everything, prioritize the highest growth stocks in Roth. Berkshire and Apple first, American Express second, Coca-Cola and Johnson & Johnson in taxable. This tax optimization can save you tens of thousands in taxes over retirement. Work with a CPA to implement it correctly for your situation. Now let me tell you about rebalancing. Once you set up this 5-stock portfolio, should you ever adjust it? My answer is rarely. The whole point of never sell stocks is that you never sell. But there are 2 scenarios where you might rebalance. Scenario 1, one stock grows to dominate your portfolio. Let's say Apple does incredibly well and grows from 25% of your portfolio to 50%. You're over-concentrated. In this case, you might trim Apple slightly and buy more of the others to get back to target allocation. But only if the imbalance is severe. If Apple grows from 25 to 35%, I wouldn't bother rebalancing. Too much trading creates taxes. Scenario 2, you need to raise cash for living expenses. When you sell shares to generate income, sell from whatever is overweight. This keeps your allocation roughly balanced. But again, don't obsess over precise percentages. These 5 stocks are all great. If your allocation drifts from the targets, it's not a crisis. Close enough is good enough. Now let me walk you through some specific scenarios so you can see exactly how this 5-stock portfolio performs in different situations. Because understanding what to expect helps you stay disciplined when things get difficult. Scenario 1, normal markets with steady growth. You're 62. You invest $250,000 in the 5-stock portfolio with the allocation I described. Markets grow at normal rates, about 8 to 10% annually. Dividends grow at 5 to 7% annually. You reinvest all dividends for the first 5 years. At age 67, your portfolio is worth about $370,000. Annual dividend income is about $6,000. You start retirement, you begin taking the dividends as income instead of reinvesting them. You also sell small amounts of stock, about 1% per year, to supplement income. By age 72, your portfolio is worth about $430,000 despite taking income. Your annual dividend income is now $9,000. You're living comfortably on dividends plus Social Security plus small stock sales. By age 82, 20 years after you started, your portfolio is worth about $600,000. Your annual dividend income is $18,000. You've been living off this portfolio for 15 years and it's still growing. This is the power of never sell stocks in normal markets. Scenario 2, severe bear market early in retirement. You're 65. You invest $250,000 in the 5-stock portfolio. you retire immediately and start taking income. Then disaster strikes. In year one, the market crashes 40%. Your portfolio drops to 150,000. You're terrified. You need 35,000 per year to live. You're getting about 5,000 in dividends. You need to sell 30,000 in stock. You're forced to sell shares at depressed prices. Your portfolio drops to 120,000. This is sequence of returns, risk in action. In year two, the market is flat. You take another 35,000. Portfolio drops to 85,000. You're in serious trouble. You start to panic. Here's where discipline matters. You cut your spending from 35,000 to 25,000. You take on part-time work earning 10,000 per year. This reduces how much you have to withdraw. You tough it out. In year three, the market recovers, up 30%. Your 85,000 becomes 110,000. You keep your spending at 25,000 plus the 10,000 from work. You're not withdrawing much. The portfolio grows. By year five, the market is fully recovered. Your portfolio is back to 180,000. You're still working part-time. You keep living frugally. By year 10, your portfolio is 250,000, back to where you started, but you're now 75. You can stop working. Your dividend income is 10,000. Social Security is 30,000. You only need to withdraw 5,000 from the portfolio. From 75 to 85, your portfolio grows to 400,000 because you're barely touching it. You made it through the worst case scenario by being flexible with spending and working part-time. This shows why sequence of returns risk is dangerous but survivable with the right response. Scenario 3, prolonged bear market similar to 2000 to 2002 or the 1970s. You're 63. You invest 250,000 in the 5-stock portfolio. Over the next 5 years, the market goes basically nowhere. Up 10% one year, down 15% the next, up 5%, down 8%, flat. After 5 years, your portfolio is worth about 230,000, including dividends. You've lost money in nominal terms. In real terms, after inflation, you've lost even more. This is frustrating, but here's what you focus on. The businesses are still great. Coca-Cola is still selling beverages globally. American Express customers are still spending. Apple is growing services revenue. Johnson & Johnson is selling medicines. Berkshire's businesses are generating cash flow. The stock prices don't reflect business value because investors are scared, but that's temporary. You keep collecting dividends. In year 6, the market starts recovering, up 20%. Year 7, up 15%. Year 8, up 12%. By year 10, your portfolio is worth 400,000. You've doubled your money from the low point. The business is compounded even though stock prices didn't reflect it immediately. This scenario tests patience, but if you understand the businesses and trust their competitive advantages, you can hold through flat or declining periods knowing that eventually prices catch up to value. Scenario 4, inflationary environment similar to the 1970s. You're 68. You're retired with 300,000 in the 5-stock portfolio. Inflation spikes to 7 to 9% annually. The cost of everything skyrockets. Your fixed expenses rise. Groceries, utilities, healthcare, everything costs more. This is dangerous for retirees on fixed incomes, but you're not on a fixed income. You own stocks that can pass inflation on to customers. Coca-Cola raises prices. American Express raises fees. Apple raises prices on devices and subscriptions. Johnson & Johnson raises drug prices. Berkshire's operating businesses raise prices. The dividends grow faster than usual to keep pace with inflation. Your dividend income was 15,000. With inflation, it grows to 20,000, then 25,000, then 32,000 over 5 years. Your purchasing power is maintained. People who owned bonds or had money in savings accounts got crushed by inflation. Their income stayed flat while costs rose, but you're fine because you own real businesses that grow with or faster than inflation. This is one of the biggest advantages of owning stocks over bonds, especially for retirees. Stocks protect purchasing power. Bonds and cash don't. Now let me tell you about the biggest mistakes people make with never sell stocks. Because knowing what not to do is just as important as knowing what to do. Mistake 1, selling when the stock is down. This is the most common and most expensive mistake. You buy Coca-Cola at $60. It drops to $45. You panic and sell to avoid further losses. Then it recovers to $70. You locked in a loss and missed the recovery. If you just held, you'd be up. Never sell. Stocks are called never sell for a reason. You hold through the downs. You collect dividends. You wait for recovery. Mistake 2, selling after a big gain to take profits. You buy Apple at $100. It goes to $250. You think, I should take profits. It's up 150%. I'll sell and buy back cheaper later. So you sell, you pay capital gains tax. Now you're out of the stock. It keeps going up to 300, 350, 400. You never get back in because it never comes back to 250. You gave up a lifetime compounder to take a short-term profit. Terrible mistake. Never sell means never, even after big gains, especially after big gains. That's when compounding accelerates. Mistake 3, selling because everyone says it's overvalued. Apple trades at 30 times earnings. Analysts say it's too expensive. You sell. Then Apple grows earnings for 10 years and the stock triples even though the valuation multiple contracts. You miss the gain because you focused on valuation instead of business quality. With never sell stocks, don't worry about valuation. If the stock gets absurdly expensive, maybe trim slightly, but don't sell completely. The best businesses always look expensive because everyone wants to own them. Mistake 4, selling because of bad news. Johnson & Johnson faces lawsuits. The stock drops 15%. You panic and sell. Then the company settles the lawsuits. The stock recovers and keeps growing. You sold at the worst time because of temporary bad news. Never sell stocks have the financial strength to survive bad news. They settle lawsuits. They fix problems. They move on. Don't sell because of headlines. Mistake 5, selling to chase a hot stock. You own Coca-Cola growing at 5% per year. You hear about some new tech stock growing at 50%. You sell Coca-Cola to buy the hot stock. The hot stock crashes. You lose half your money. Meanwhile, Coca-Cola keeps steadily compounding. You traded a sure thing for a gamble. This is how people destroy wealth. Stick with your never sell stocks. Ignore the hot tips. Mistake 6, selling because you think you can time the market. The market is at all-time highs. You think a crash is coming. You sell everything to avoid the crash. But the market keeps going up for 2 more years. Then when it finally crashes, you're too scared to buy back in. You miss gains waiting for a crash, then miss the recovery after the crash. Market timing doesn't work. Just hold. Mistake 7, selling because you need money. Life throws you a curveball. Medical emergency. Family crisis. You need $50,000. You sell stock to raise cash. But this was money you needed for retirement. Now you have less compounding for your future. The mistake was not having an emergency fund. You should have 3 to 6 months of expenses in cash before investing. Never put money in stocks that you might need in the next 5 years. Only invest money you can leave alone for decades. If you avoid these 7 mistakes, you'll do fine with never sell stocks. The strategy is simple. The execution is hard because emotions and circumstances tempt you to sell. Resist, hold, let the businesses compound. Now let me give you a detailed comparison showing why this 5-stock portfolio beats alternative strategies for investors over 60. Alternative 1, high dividend stocks. Some people over 60 chase high yields. They buy stocks yielding 6, 8, 10%. Sounds great, high income now. But these high yields are usually a red flag. The yield is high because the stock price has fallen, and the stock price fell because the business is struggling. These companies can't sustain the dividend. They cut it. The stock crashes further. You lose your income and your capital. Compare this to the 5-stock portfolio. Lower yields initially, 3 to 4% average, but the dividends are safe and growing. Over 10 years, you'll have higher income than the high yield strategy, and your capital will have grown instead of shrinking. Alternative 2, bonds. Many people over 60 think bonds are safer than stocks. They put money in 10-year treasuries yielding 4% or corporate bonds yielding 5%. Safe, right? Wrong. Bonds have two problems. First, the income is fixed, 4% today, 4% in 10 years, 4% in 20 years. Inflation erodes purchasing power. What buys you $40,000 of goods today buys you $25,000 in 20 years with just 3% inflation. Your standard of living declines. Second, if interest rates rise, bond prices fall. You can lose principal. The 5-stock portfolio solves both problems. Dividends grow with inflation. Stock prices grow over time. You maintain purchasing power. Alternative 3, annuities. Insurance salespeople love selling annuities to people over 60. You give the insurance company $250,000. They guarantee you $15,000 per year for life. Sounds safe, but there are problems. The payout is fixed, no inflation protection. The insurance company keeps any money left when you die. If you die after 5 years, they keep $175,000. Your heirs get nothing. And if the insurance company goes bankrupt, you might lose everything. The 5-stock portfolio is better. You keep control of the assets. The income grows. When you die, your heirs inherit the portfolio, probably worth more than you paid. Much better deal. Alternative 4, cash and CDs. Some people over 60 are so scared of losing money that they keep everything in cash or certificates of deposit. Zero risk of principal loss, but massive risk of purchasing power loss. Cash earns 0. CDs might earn 3 to 4%. Inflation is 3 to 4%. You're running in place. In 20 years, your $250,000 is still $250,000 in nominal terms. But in real terms, it's worth $130,000. You've lost half your purchasing power. The 5-stock portfolio grows your capital and your income. After 20 years, your $250,000 is probably $600,000 and generating $40,000 per year in dividends. Vastly superior. Alternative 5, individual stock picking. Some people over 60 think they can pick better stocks than my 5. They buy 30 stocks they heard about or researched. The problem is they don't understand those businesses deeply. When one stock drops, they panic and sell. When another stock rises, they sell to take profits. They trade too much. They pay taxes. They underperform. Studies show that individual investors who pick their own stocks underperform index funds by 3 to 5% annually due to trading, emotions, and poor timing. The 5-stock portfolio solves this. You own only businesses you understand. You don't trade. You avoid taxes. You stay disciplined. You outperform. Alternative 6, target date funds. These are mutual funds that automatically adjust from stocks to bonds as you age. Sounds convenient. But they have problems. Fees are higher than index funds, usually 0.5 to 1%. The glide path might not match your needs. They shift too aggressively to bonds, reducing long-term growth. The 5-stock portfolio lets you control the allocation, lower fees, better customization. The comparison is clear. For investors over 60 who want income and growth, the 5-stock never sell portfolio beats all the alternatives. Higher long-term returns, growing income, lower taxes, simplicity, peace of mind. Now let me talk about what to tell your family about this portfolio, because estate planning and communication matter. If you're over 60 and you build this portfolio, it might be your largest asset. Your heirs will inherit it someday. They need to understand it. Here's what you should tell them. First, explain the never sell philosophy. Tell them these 5 stocks are not like other stocks. They're not to be sold when they inherit them. They're to be held forever. These businesses will compound for their lifetime and their children's lifetime. Selling them to raise cash is the worst thing they could do. If they need money, sell other assets first. Keep the 5 never sell stocks. Second, explain the dividend reinvestment strategy. If they don't need the income, they should reinvest all dividends automatically. This accelerates compounding. Over their lifetime, this could be worth millions in additional wealth. If they do need income, they can take the dividends, but encourage them to take as little as possible and let the rest compound. Third, explain that market crashes don't matter. There will be times when the portfolio drops 30 or 40%. This is normal. These businesses are still great. The dividends keep coming. Just hold. Don't panic. Don't sell. Eventually, the market recovers and new highs are reached. This has happened dozens of times in history and will happen dozens more. Fourth, encourage them to add money when possible. If they have extra cash from bonuses or inheritances or whatever, add it to this portfolio. Buy more of these 5 stocks. The more shares they own, the more dividends they receive, the wealthier they become. But only add money they can leave invested for decades. Fifth, warn them about financial advisors who will try to complicate things. After you're gone, advisors will contact your heirs. They'll say the portfolio needs to be diversified. They'll recommend adding emerging markets or commodities or alternative investments. They'll suggest moving everything to managed funds. This is self-serving. They make fees from managing money. Your 5-stock portfolio requires no management. Tell your heirs to ignore these advisors. Keep it simple. Keep the 5 stocks. Don't let anyone complicate it. 6, explain the tax strategy. If they inherit in a taxable account, they get a step up in cost basis. The cost basis resets to market value on date of death. They can sell immediately tax-free if needed, but encourage them not to sell. Just hold and let it keep compounding. If they inherit in retirement accounts, different rules apply. They have to take required minimum distributions, but encourage them to take only the minimum required. Leave the rest to grow. 7th, suggest they pass it on to their children. This portfolio can compound for generations. If they hold it for their lifetime and pass it to their children who hold it for their lifetime, this could turn into tens of millions over a century. This is generational wealth. Multi-generational compounding is the real secret to building dynastic wealth. Have this conversation with your family now. Don't wait until you're on your deathbed. Explain the philosophy. Show them the numbers. Help them understand why these 5 stocks are special. This ensures the wealth you've built continues benefiting your family for generations. Let me close with a personal story that illustrates why never sell stocks matter so much. In 1988, I invested $1 billion of Berkshire's money into Coca-Cola. At the time, people thought I was crazy. And Coca-Cola was already a huge company. It wasn't cheap. We paid about 3 times book value, 13 times earnings. Expensive by my historical standards. But I understood the business, I understood the moat, I understood the potential. I bought and I held. 37 years later, we still own that Coca-Cola. The stake is now worth about $25 billion. We've received probably $20 billion in cumulative dividends over the years. Total return is about $45 billion on a $1 billion investment. That's 45 times our money, a 4,500% return. How did this happen? Not through trading, not through market timing, not through anything clever. I bought a great business at a fair price and I held it for 37 years. That's it. The business compounded. The dividend grew. The stock price followed. Berkshire benefited enormously. This is the power of never sell stocks. If I had sold Coca-Cola at any point because it looked expensive, because it had a bad quarter, because some analyst said to sell, because I thought I could time the market, I would have missed most of the gains. But I didn't sell. I held. I collected dividends. I let the business compound. And we made $45 billion. You can do the same thing on a smaller scale. Buy the 5 stocks I've outlined. Hold them for 30, 40, 50 years. Don't sell. Collect the dividends. Let them compound. In 30 years, you could turn 250,000 into 3 million. In 50 years, if you pass it to your children and they hold, it could be 10 million or more. This is how wealth is built. Not through trading, not through speculation, through owning great businesses and never selling them. That's the lesson I want you to take from this. If you're over 60, you don't need to swing for the fences. You don't need to find the next Amazon. You just need to own 5 great businesses that will compound for decades. Coca-Cola, American Express, Apple, Johnson & Johnson, Berkshire Hathaway. Buy them, hold them, never sell them, let them work for you. In 20 years, in 30 years, you'll be so glad you did. This is how you invest after 60. Simple, patient, disciplined, boring, and incredibly effective. Start today. Buy these 5 stocks, then live your life. Let the stocks do their job in the background. That's the whole point. Investing should free you to live, not consume your time and energy. These 5 never sell stocks give you that freedom, peace of mind, growing wealth, rising income, everything you need. The choice is yours. Make it today.